Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. So we've had much stronger economic activity. If you recall, as little as 3 or 4 months ago, the big concern in global markets was of recession in 2023. And now, of course, activity is much stronger than expected. So the pendulum of anxiety has swung from recession to inflation. It's a case of good news being bad news, at least for the markets. It's obviously reasonably good for those people who are looking for a job and want decent wage increases, but less good for the markets. It's less good because higher inflation means higher interest rates. It means bond yields go up, and therefore there's a pressure on valuations. So just to kick off, I don't have all the details in front of me, but if we look at PMIs, Purchasing Managers Indices, those are forward-looking, very accurately, very closely watched survey data, and the latest that's come out of China is incredible. It's a huge increase. Manufacturing PMIs jumped to its highest in 10 years since 2023. So the China PMI was strong. There was a call from economists saying that the euphoria over China's reopening has pushed markets higher in January, beginning of February, and then the markets have dropped a little bit since then. But of course, it would take a couple of months for the data to come out in the surveys, or at least the activity in the economy to be reflected in the surveys. And Capital Economics, I remember, said wait till March. We have incredible PMI figures from China. But PMIs around the world are looking very good, both manufacturing and services, improving sentiment, and all that coupled with easing supply pressures, which bodes well for input prices. In the UK, the composite PMIs rebounded from 48.5 to 53, taking it above that neutral 50 level for the first time since last July. In the US, from 46.8 to 50.2, above 50 for the first time since June. In the Eurozone, the composite PMI increased sharply from 50.3 to 52.3. So all looking good. There's going to be a bit more on the European or Eurozone PMI just now. Forward-looking components, positive new orders edged into expansionary territory in both the UK and the Eurozone, and sentiment also improving, which suggests future output will be increasing across all major advanced economies. The composite input price indices have fallen in all cases outside Japan, taking them well below their early 2022 peaks. Other survey data in the Eurozone, the biggest economy in the Eurozone, the German ZEW survey economic sentiment indicator increased from 16.9 in January to 28.1 in February, and that's well above consensus forecasts and a huge increase from September's low of minus 61.9. In Europe, we have an increase, the composite increase I mentioned already, from 50.3 to 52.3, and that's consistent with economic growth quarter on quarter, GDP growth in the first quarter of around 0.3%. So astonishing turnaround from earlier forecasts that we're going to be getting recessions and declines in GDP of anywhere between 1.5% and 2%. So looking good. Also, the manufacturing suppliers delivery times index is now above its long run average, indicating that delivery times are shorter than usual. It does indicate that supply chain disruptions are well behind us. And also the manufacturing input price index at its lowest level since September 2020. Nice improvements there. What does all this mean for inflation? So I suppose one of the big question marks is China's rapid economic growth. Last year, China grew by 3%. This year, it's very likely China will grow in excess of 5%, probably 5.5%, even 6%. Economists are busily sharpening their pencils after this morning's PMI publication. So 2 points here from Capital Economics. In fact, 3 points. They say that supply chain disruptions are unlikely to be an issue with the COVID reopening. The virus has already passed through the workforce. Chinese manufacturers now appear, in addition to that, to be sitting on large amounts of inventory. And third, on that segment, global demand for China's exports is now substantially weaker than what it was. So supply-driven surge in inflation from China's reopening is highly unlikely. Second of all, what about demand-side developments? Well, interestingly enough, Chinese spending is focused primarily on domestic services, which have, of course, a low impact on global inflation. The biggest risk, in fact, of global inflation is Chinese demand for commodities, in particular energy, but they make the point here that other major economies around the world are experiencing a decline in energy demand. So net, little to worry about in terms of China's inflationary impact on the world. However, turning to US inflation, not looking so rosy. Last week we had the release of personal consumption expenditure data and inflation, and this is the inflation data point most closely watched by the Federal Reserve. And in January, the core PCE inflation figure increased by 0.6% month on month, pushing core inflation, year-on-year core inflation up from 4.6 to 4.7. Both goods and services prices increased by 0.6% month on month. And the Fed's preferred PCE services, excluding housing, increased by close to 0.6% month on month, a notable acceleration on recent monthly gains. So, of course, that's bad news. It all stems from a much stronger than expected US economy, particularly consumer spending. Personal spending in real terms increased in January by a whopping 1.1%, and that's month on month. So you compare that with declines, back-to-back declines in November and December of 0.3%. So a big turnaround there. So Capital Economics expecting overall GDP growth in the first quarter of 1.5%. Big increase in growth. So if we turn now to some of the macro asset allocation views, first of all, Edison, they're moving their recommendation on global equities from overweight to neutral. We now question whether 2023's rally in global equities can be sustained. Asset allocation, where to invest. Strong capital flows into EM are often a trigger for rising asset values. After several years of net capital outflows, there are compelling signs that these flows are finally turning around. Note again several years of net capital outflows. You couple that with the fact that EM are incredibly cheap compared to their long-term history and versus other markets. Very quickly, 3i Group, the fourth quarter of calendar year last year, NAV increase of 11.7%. For the first 9 months of financial year 2023, NAV increase of 26.8%. Their biggest holding, Actium, comprises 60% of NAV year-on-year sales for the 12 months to the 1st of January, driving a 46% increase in EBITDA. 280 stores added during the year, bringing the total number to 2,263. So very positive there. Also, Greencoat UK Wind has very strong inflation defense. Its pricing is linked to inflation. Incredible fourth quarter, that's the calendar year NAV return of 9.1%, including the dividend. They have very conservative energy price forecasts, which suggests little volatility to their NAV from changes in the power price curve over the next 5 years.
Hi, Nick. Foreign selling of local equities year to date. Last it was 15 billion rand. At the moment it stands at 18 billion rand. It's quite a lot. It's picking up. Then just to remind you that our inflation rate is for January stood at 6.9%. The repo rate now is 7.25% and the prime rate is standing at 11.75%. Then statistics. The first one is the producer price index. That's the prices at the factory gate or at the farm gate. It was very high in July last year. It stood at 18%, but it came down every single month, and in January it stopped at 12.7%. It is coming down a lot, which we like. It is still too high, and the reason why it's coming down is they say the coal prices are a bit better and the petroleum prices are also better. Then the private sector credit extension, that's a credit that the banks give to the private sector. There was a rise of 8.42%, which is good. The previous month it was 7.73%. These figures are at a very good level. There's no problem there. And then the balance of trade. The balance of trade is just the difference between our imports and exports. And we've done very well up to now, except in January, there was a mistake. We always were positive with this balance of trade. And in January, we were actually negative with 23 billion rand. That's the first time in more than a year that we've had a negative month for the balance of trade. And then the money supply, which we call the M3, that's also climbing a bit. It's up to 9.57% in January. The previous month it was 8.6%. And that curve is positive, is upwards, so nothing wrong there.